Welcome to the Jill on Money Show. It's Friday, May 3rd, and I know you are as excited as I am about today being the first Friday in the month, which means it's a jobs report Friday. I feel your enthusiasm bubbling through the airwaves. I know. Okay, so the expectation is that job growth is going to start slowing down. We had a very sizzling first 3 months of the year. I don't know. Maybe they'll revise some of those down, but it really is pretty remarkable that the job growth has been as strong as it's been. I think we averaged 276,000 jobs a month for the first 3 months of the year. Last year it was more like 250,000 a month. So I don't know. It's going to have to slow down some. And I know you're probably thinking like, well, what of all these layoffs in media and tech and what's going on? I guess that other people are hiring. So the economy is growing. We did see slower growth in the first quarter of the year. But I don't know, this job growth, it is certainly propelling consumers. We are spending money, and that's helping the economy kind of stay as strong as it's been. Unfortunately, it is also keeping prices higher than we'd like. So we'll give you an update if anything changes. But, you know, if it's 200,000, 250,000, if it's something in that range, I don't know, could be 200 to 300,000. And if it's something really outlandish, we'll let you know. Promise. Okay. So this is the program that takes the mystery out of your financial life. If you've got a question, all you need to do is go to JillOnMoney.com. Yay! JillOnMoney.com. Click the contact us button. Let's get to some emails. This is from Ian, who says, my wife and I have an emergency fund with about 10 months of our living expenses. The emergency fund is in a bank savings account, and the interest rate is, you ready? 0.02%. Oof. Is there a better place to park that emergency fund to keep it protected, accessible, and also put it to work for us? Absolutely. By the way, all the big banks, they actually have terrible, terrible interest rates still. So you have to be a bit more proactive. And I know that is a pain in the butt, but here's what you can do. First of all, you can buy a CD with like a few months of that. You know, that's one thing. You can just keep it at the bank. You can move some of this money into a brokerage account where you will get a higher money market rate. Or you could take some of it and go into, say, an online banking product or an online savings account. Go to depositaccounts.com and you'll be able to find something, I think, that will be certainly a lot better than 0.02%. But if you want to keep, sometimes people say like, I just want to keep the money in the same family, in the same account. In that case, just, you can certainly buy a CD. It's not a problem. Okay. Next up, Nancy writes, my question is, if I were to do a QCD, a qualified charitable distribution at age 70 and a half, how would that affect my RMD, required minimum distribution, when I turn 73? Okay. So here's what happens. A qualified charitable distribution is you're taking money that's in an IRA account and you are sending it directly to charities. And it's so, again, you're taking a pre-tax IRA account. Money is going directly to a charity, and you can do up to $100,000. So it doesn't have to be one charity. You could do 10 charities, 10 grand each. That money comes out of the account. You will not get hit with a tax liability because it's going straight to the charity. And how that would affect your required minimum distribution is the total amount inside that IRA account is lower. So it should, again, if your account does incredibly well and it just keeps getting bigger and bigger, it's not going to maybe move the needle so much. But if it's $100,000 and, for the next couple of years and you get to 73, you should have a lower required minimum distribution when you turn 73. Okay. Jennifer writes, can an inheritance be turned into a revenue generating stream? Here's the question. My husband's mother passed away earlier this year. Her estate was about $400,000. She wants to give 3%. She wants to, that's funny. Meaning, I guess she has this in a will, wants to give 3% to a sister, and then divide the rest equally among her 6 children. My husband would like to turn the funds into some sort of revenue generating tool. Is there a way to do that? We're also looking at paying off some credit card debt and also wondering if we can lend money to ourselves to pay off our car. He's wondering if it would be best to put these funds into some kind of retirement or financial tool. Okay, wait a second. Are you talking about your husband is doing? So I'm trying to understand if this is all happening like before you make the distribution or not. But let's just say that what happens is sister gets 12 grand, right? Isn't that what you said? Yeah, 3%. So you have $400,000 less this 12 grand. Okay. And now there's 380 grand, 88,000. Now you take, that means you each get about $65,000. So the first thing that I would say is this: don't put this amount of money into anything. Make the distribution. So if you have $65,000 and right now, out of that $65,000, your absolute number one priority is to pay off all your credit card debt. So that is about 22.5. So you get your 65,000. I'm doing simple math, and we're going to pay off your credit card debt, which leaves you with $42,000. Then you're going to, instead of lending yourselves money, take $15,000 and pay off your car loan. Now you are left with $27,500. That money should be used to, number one, make sure that you have an emergency reserve fund. I bet you don't, because you have credit card debt. Number two, we can look at maybe putting some money into a retirement account. But the real issue here, Jennifer, is that you guys have to look at what your needs are. And I think that you really have to be clear that this money is kind of a gift, and we have to figure out why is it that you're in credit card debt. And I'd love to have you follow up with us. Okay. This is from Nora, who says, I am the trustee of a trust that my father established for his 6 grandchildren. Okay. 5 are young adults. 1 is 14. The trust should pay out in 5 years. Okay. So it's $750,000 with Vanguard in 3 funds. He was a do-it-yourselfer. Okay. I'm not scoffing. She says, don't scoff at it. No problem. 300 grand in a Target Retirement 2030 fund, 400,000 in a Target Retirement 2025, and $40,000 in a Treasury money market. And Nora says, I use this to pay the trust federal and state taxes. Do you have any suggestions for how to prepare to eventually distribute these assets? Should they be split into 6 accounts now? Should they be sold, bite the bullet, pay the taxes, and buy different funds? Is this too complicated for a do-it-yourself, or should I consult a tax expert or a financial planner? Well, I mean, it's not complicated. Okay. So the trust has got a 5-year time horizon. Okay. And that means in 5 years, we are going to make distributions to 6 different accounts. And the young adults, they get theirs. It's not like you're withholding it. It's just going to get paid out. And then in 5 years, your 14-year-old is going to be 19. So I don't know if there's any stipulation about when that kid gets the money. You know what I mean? Like sometimes they stipulate that it's 21, 25. Okay. But that said, I don't think you need to do something that's so different. You could, but nothing bad's going to happen here. It's just that when you get closer to needing this money, you'd want there to be less risk. The only reason that I would consult a CPA is to understand what is the tax liability when the trust pays out. Should the trust pay the taxes on the gains, or should you distribute the funds to the heirs because their tax bracket will be lower than the trust tax bracket? That's the only reason I would say that this is you need a tax consultation. I don't think there's a big problem though. I really don't. Okay, this is from Cheryl, who says, this is like so weird. It's like, this is crazy. Cheryl's going to receive money from a life insurance policy, and she doesn't want to put it in the stock market. It's going to be $158,000, wants something safe and earn some interest. Well, Cheryl, depends when you need it, but if you really don't want any risk, then go to depositaccounts.com and buy some CDs. That's it. And you can buy longer term CDs, but if you need it anytime soon, make it some short term, maybe a 1 year, a 2 year, a 3 year. But if you really don't need this money at all and you don't want to put it in the stock market, you can certainly put a bunch of it in CDs. And that's it. That's what you would do. No risk. But when the CD comes due and interest rates are lower, you're going to have to make another decision. Okay. This is from William. I listen to your podcast every morning. I love the show. Okay, here's the question. I've got 4 small whole life policies I bought in my 20s. Each one has a face amount, a death benefit of $50,000. Oh my gosh. So now I'm 65 and I'm retired and paid the premiums every year as they are due. The death benefit is around $328,000 and the cash value is $147,000. I took out conservative policy loans, about 30% of the cash value, to help pay for college costs, and I pay the interest every year. One loan is at 5.5%, the other is at 8%. My kids are all launched and on their own. Although the death benefit would be nice for my spouse to have upon my death, it's not critical to her survival after I'm gone. Should I pay off the policy loans? I have plenty of money to do it. Should I keep paying the annual premiums forever? Maybe use the dividends to pay premiums. Thank you very much for your help. Well, it's funny with these old whole life policies, it's always good to get like a fee only financial advisor, someone who's going to look at this and really crunch the numbers. My gut here is that you don't have to keep paying them off. But what I would do is I might contact the insurance company and say, I don't want to pay anymore. What would the paid up value be of these policies? In other words, if I never made another premium payment, what would happen with these policies? Would they stay in force? Would they not? I don't think you have to pay off the loans, but I'd rather have a paid up policy and not worry about your cash flow at all. But I do think having a impartial party to analyze this would be helpful. And I think worth the money, by the way, to do that. So why don't you check that out and let us know how that goes. Okay, that's it. That's the program. Oh my gosh, it's a Friday, so I get to do some business. So first of all, don't forget, we are always reachable by going to our website, jillonmoney.com. Click the Contact Us button. Let us know if you want to come on the air. Our music is composed by Joel Goodman. Mark Talercio is our executive producer and king of all things web. We are distributed by Odyssey. Please, please put your hands metaphorically or physically on someone's back. Give someone a hug and change your work, change your wealth, change your life. Thanks for listening. We'll talk to you tomorrow.